This is Robert Kraft, and I'm your host on Planet MicroCap. And joining me right now is Darren Minton, CEO of Smart for Life, Inc. It's a publicly traded company. The symbol is SMFL on NASDAQ. Darren, thank you so much for joining me today. How are you doing?
Thank you, Robert. Doing well. Thank you for having us today. Pleasure to kind of meet you in the audience.
Absolutely. Same here. So this is our first time doing an interview together. So can you start us off with a quick overview and history of the company?
Sure. More than happy to. So Smart for Life, Inc., we're all about health and wellness. We're in the health and wellness industry. We're growing through acquisition, and it's both vertical and horizontal integration. So by that, we're both buying contract manufacturing subsidiaries of ours that concentrate on maybe pills, capsules, tablets, whey protein shakes, collagen, pretty much anything you could imagine at a GNC or vitamin shop we can make. We also have food products. You can see some of them behind me. We have Smart for Life bars that are very popular. Those are sold in Costco, Walmart, various other big box retailers, as well as online. And we're growing through acquisitions. So not only through the acquisitions we've acquired, we'll get into some of those later in the call, but also through acquisitions that are in our pipeline. Right now, we're currently at a roughly $20 million run rate based on our SEC financials. We just went public in February, but we have in our pipeline, and we've disclosed this with the SEC, about $100 million we expect to achieve in the next 12 months of revenue. And in the next 36 months, we expect to achieve $300 million in revenue. There's no way we'd be able to do that, simply through organic growth alone, but that's organic growth combined with our acquisition activity. So we're looking forward to kind of sharing that activity with the market as we continue to make acquisitions.
So then what's your criteria for a potential acquisition?
Sure. A couple things. One, has to be in the health and wellness industry. We're not going to acquire something that doesn't relate to our business, that has a synergy. But if it's a manufacturer or if it's a great brand that we may want to acquire, that's something that we can look into. So that's step one. Step two is I have to have proper metrics. So we're buying well-run businesses that have positive EBITDA. All of our acquisitions are based on an EBITDA multiple, ranging anywhere from a 4 to a 6 or 6.5x EBITDA. And we like to work with management teams that want to stay on board. So that's all about risk mitigation. We don't want to buy a brand, change it overnight, and see attrition of revenue the next day. What we want to do is buy well-run companies, keep the management intact. The phrase we use, the motto is we like to keep the DNA intact. If it's a well-run company, we don't want to throw the baby out with the water, but keep the management intact. We convert they're kind of paid to a salary. And a lot of times when we work with management teams that have been successful in the past, they may have hit a ceiling. We can help them break through that ceiling, and they can focus on what they've done best. Perfect example is Dr. Scientific Organica, Smart for Life. The brand itself has been around for about 15 years. When we acquired this company, we changed the corporate name to Smart for Life. Dr. Sassam Alabi, who's been fantastic, really was kind of hitting some ceilings as far as growth potential. So we bought the business. He's now our chief medical officer. He's fantastic in that role, and he's able to focus on what he does best, which is helping with the brand, helping with making more online videos, really promoting the products and the weight loss and the protein bars, while we're able to help the company grow and logistically help out operations.
Absolutely. That actually touches on my next question is, not every company that, might be privately run company is saying, oh, wow, I'm, an offer for me to be bought. I'm taking it. They might also see that as like, oh, there's an offer in here. Maybe I should hold out for, because for all intents and purposes, you're a microcap company. That's why we're talking right now. So what's some of that when you game it out, and you're starting to think, okay, what's really the value add for the potential acquiree to want to come under the Smart for Life banner?
Yeah, and it's a couple of things. So, typical seller, Dr. Sass, again, great example. So he was looking to sell his company. He had actually engaged a sell-side business broker to, sell his company. Some of the offers he was looking at might be an all-cash deal, or maybe it's, a venture debt fund that might want to buy the company. So one of the things that the broker was saying to us when we first approached the company a year and a half ago, or more, actually, almost 2 years ago now, with COVID, time flies, was, hey, I want to sell my company, but I still, want to have a percentage of the company. It's been my baby. I want to, still own a piece of it. I don't know, 5 or 10%, something like that. So, that's kind of typical seller when they're thinking about it from that perspective, if they're going to do a private sale. So we said, look, that's not our strategy. That's not how we typically acquire companies. If it doesn't work for you, that's fine. But the way we acquire companies is we buy 100%. Instead of giving you a percentage of your private company, which is harder to sell, that's a private transaction later down the road. If you want to sell that 10%, we will give you a percentage in the overall parent company based on a certain formula. So we have 3 buckets for the seller, based on their purchase price, which again is a 4 to 6x multiple for the overall purchase price. We then split that into buckets. One bucket's cash. So a lot of times half of the purchase price is just straight up cash that they get immediately. And then typically it's 25% in a seller note. So something that's deferred gratification. It can be a seller note or an earnout. And then the other 25% is stock. And so for certain management teams that may not be interested in stock, if they're older and just want to retire and go to the beach, maybe that acquisition strategy doesn't make sense. That wouldn't make sense for us. So it's a nice kind of filter process. Also because we want to keep the DNA intact and at least have some semblance of normalcy for a year or 2 after acquisition. Usually we have an employment agreement that matches the term of the note. So if it's a 3-year note, we'll have a 3-year employment agreement. So for some people that can be great. Dr. Sass, it was perfect. He wanted to keep some upside potential, if you will. So for him having a purchase price that was based on that 6x multiple roughly, and having a portion of it in stock, which can appreciate dramatically over time, not only with the success of the company as it is now, but also with other acquisitions, that just inures to everyone's benefit and a rising tide kind of raises all ships. So that's kind of the rough benefit for sellers. And quite frankly, if there's a seller that says, I don't want any stock whatsoever, they're probably not in it for the long term. So it's nice that we know ahead of time, okay, that may not be a good deal for us. And then we can kind of go and meet another seller that might be interested in that. So for us, it's great. One thing we didn't envision was COVID, which in some ways turbocharged the market and made everyone think about health and wellness way more than they did in the past. Now, with COVID being on people's minds, people are thinking about, immune products. It's not just, hey, if I get sick, I'm going to go to the hospital and get COVID cured. It's also, hey, how can I help my immunity in advance? Make sure I'm getting enough vitamin D, vitamin E, all these other things that may help keep your immune system as strong as possible. Working out, a good diet, all those things can help. Now that people are thinking about that more, even in a crazy economy where we've got inflation and recession, possibly, health is one of the last things that people kind of cut from their routine.
So I also want to ask about some recent acquisitions that have been announced and closing potentially, for your sake, hopefully soon, right? Is on the Ceautamed Worldwide. On June 8th, you announced that the company's on track to close this pending acquisition. So love an update there. How are we doing?
Yeah, we had hoped to get the acquisition closed by June 30th. We're still, hotly anticipating getting the closing done. We already made $1 million payment to the sellers. In that case, and we're still on track to finish by the end of July, hopefully sooner. We'd love to get everything finished by mid-July if possible. Part of it is just the crazy economic market we are in. We're getting the last part of the raise completed, but we're making great progress on that. We should be making some announcements on that closing very shortly. So stay tuned. We're excited about that. The thing that excites us most about the Greens First acquisition, Ceautamed Worldwide is the legal entity. But as far as consumers are concerned, nobody calls the product Ceautamed. It's Greens First. So that's the brand that we're really acquiring within Ceautamed. It's a great product. Check out the website, greensfirst.com. What's nice is it's got a lot of other synergies with our other business sectors and units. So it's got some great things that we'll be able to synergize with our manufacturing. So for instance, they currently have about 1.5 to 1.8 million of cost every year because they're a brand where they outsource their contract manufacturing to third parties that make their product, and then they sell it primarily in doctor channels. So what's nice is with our other subsidiaries like Bonsante Natural Manufacturing in Doral, Florida, we're able to take all of that cost and move it in-house. So even though Ceautamed or Greens First still has that same cost structure per se, that's extra revenue, roughly 1.5 to 1.8 million of extra revenue for our other subsidiary because we can now manufacture that in-house. And the other benefit is during COVID, it's not just, cost and making margins, it's also about just making sure you actually have product to sell on the store shelves with the logistics going on in the global supply chain. So by having more control over that process, we love that. That's great in this kind of uncertain market where we can, actually manufacture it, make sure it's on store shelves, and in this case, in doctor channels, and go out that way. The other benefit too is because it's primarily doctor channels, we can now, take some of our other products, protein bars and things of that nature, and cross-market that into doctor channels where we don't have a huge presence. Likewise, Greens First, which is basically vegetables in a capsule. If you go to a doctor that's in that network and you don't have enough vegetables in your diet, they can actually recommend, hey, why don't you take greens first? It's vegetables in a capsule. So it comes recommended from a doctor, you're pretty likely to take the supplement. Just if the doctor says, hey, you need more vitamin D, go to CVS, get some more vitamin D in your system. What's nice is they're starting now to market that product online, direct to consumer, whether it be on Amazon or directly on their website. But they're not pros at that. We are. All of our products, including Smart for Life products, have great distribution and throughput online. So we're able to kind of help our products, sell more in doctor channels, conversely take their product greens first and really turbocharge that with our existing products, including Nexus offers that we acquired this past year.
Gotcha. And what's your background? I mean, I saw the company announced that you became officially CEO. I think it was May 5th that was announced. So I'd love to hear your background prior to joining the company.
Yeah. So my background is primarily in the capital markets, building companies. Went to Stanford economics. That's my kind of core background. I was in New York for about 12 years. In various forms of corporate finance, from merchant banking, worked at First Republic Bank as well in San Francisco, taking companies public, worked a lot at Trilogy Capital Partners and with our chairman, AJ Cervantes, over the past 10 years, really growing companies, advising companies, financial communications, worked with over 200 public companies during that time frame. And so now taking that into Smart for Life, which is a company that we formed in 2017, over that time period have gotten 4 acquisitions done. Bonsante Natural Manufacturing was our first acquisition. Again, our contract manufacturing subsidiary in Doral, Florida, suburb of Miami. Our second acquisition was Dr. Scientific Organica. So this acquisition here, where I'm at, where we make our protein bars. Later that year, right before our IPO, we got Nexus Offers acquired, which is a company that focuses on digital marketing and affiliate marketing channels in the health and wellness industry. So that's turbocharging all of our products and our sales online, including Greens First when that closes. And then our most recent acquisition that we just acquired right before our IPO in February was Sports Illustrated Nutrition, which we're really excited about. So that is a way for us we own that brand in a licensing agreement with Authentic Brands Group, which is a great company based out of New York. They own a lot of different brands under a lot of different umbrellas, Brooks Brothers, Forever 21, Sports Illustrated, obviously. They just closed Reebok from Adidas for $2.4 billion a couple months ago. And they also own a lot of celebrities and likenesses. So Shaquille O'Neal, Elvis Presley, Marilyn Monroe. So being able to work with them on the Sports Illustrated product, we actually have some samples over here. So this is the branding of the product as far as the prototype. So this is going to be on sportsillustratednutrition.com. The website's already up. We're getting the product up, and those will be starting to sell in this next quarter. We're excited about that and launching some new products, including some protein bars potentially under our various brands and portfolios. We already have the Smart for Life protein bars, but putting different brands underneath that existing formula, we'll be able to kind of cross market as much as possible.
Very cool. All right. So my final question for you today, and to close this out, I wanted to harken back to something you said at the very beginning. Right now you're at a 20 million run rate. In 36 months, you're targeting to get to 300 million. It's aggressive, right? I mean, love to hear what are some of the value catalysts that you feel will ultimately result in getting to that goal that you're hoping to achieve there.
Yeah, I mean, it's exciting. It's something that is aggressive, but the other thing as well is it's a hockey stick. Right now we've done 4 acquisitions. All of those were done, the ones that have closed, before our IPO when we were a private company. So now we've got, even though the market's a little crazy right now, we're continuing to get acquisitions done. Greens First is going to get done. We always find a way, no matter what, by the end of July. So that acquisition will be completed. And the acquisitions after that, which we've already announced at several of the conferences we've gone to, the Noble Conference, H.C. Wainwright, we've announced publicly that the acquisitions are much bigger in the pipeline from here on out. In some ways, it seems counterintuitive sometimes, but if you're sophisticated, you know that sometimes it's the larger acquisitions that are actually easier to do. A larger company, the acquisitions later in the pipeline are 40, 50 million in revenue. So, just one acquisition, boom, you're adding on something that's actually larger than our size. That really helps us get to that $300 million goal much quicker. The reason that they're sometimes easier to do is that, a larger company is more likely to have audited financials. probably isn't on QuickBooks and more likely to be on a better ERP system. They have better systems and procedures in place. A lot of times the due diligence process is a lot quicker with an acquisition like that. And in some ways too, in this adverse market environment, which is kind of the least you can say, the larger financing and deals are sometimes easier to get done. There's more cushion built into the overall deal structure. A lot of times, deploying capital for a lot of these funds and family offices is, easier to do when it's larger sizes. And also as well, you're getting a lot more done. Bankers like that more. The fees that you get paid are larger, and it still takes just as much time and due diligence for a $5 million revenue company as it does for a $50 or $100 million company. So that's really how that hockey stick starts to take out, is larger deals over the next year. And also we're going to be larger as well. So once we get that next acquisition done of 50 million, then we'll be at 70 or 80 million, and then getting the other one done at 100 million, we'll be able to step up and continue to get larger pieces done and hit that goal in no time, despite the crazy market conditions. And the other thing that helps too, despite our stock and our share price, we believe, being very depressed since the war in Ukraine and everything else going on in the public markets, we're going to be able to continue to get deals done based on our structure, even if a lot of these financings are done with debt. So the nice thing is, we're not beholden to have to raise equity at, we believe, these very depressed prices. We can still get deals done with debt, obviously, in the future when our share price equates to something that makes more sense for the market and our shareholders. Then we'll do deals that have more equity components. But even being able to get things done in debt in these adverse times, we're able to grow when markets are adverse, and then continue to accelerate that going forward.
Very good. All right. Well, Darren, with that, where can our audience go and find more information on Smart for Life?
Yes, you can go to smartforlife.com for our retail products, kind of like Disney.com. Go there for the park and everything. And then our investor site and our corporate site is smartforlifecorp.com. So we have the corp at the end for everything investor relations. And thank you so much, Rob, for having us today. We really appreciate it.
Absolutely, Darren. Thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
Thanks, Rob. Appreciate it.
Thank you.